So in today's video, I want to do a follow-up to the recent video that we have produced on credit spreads and the best practices for this type of strategy. And I want to answer a question that we've been getting from some investors, which is, can you lose more money than the max risk on a credit spread? Because we've seen a few different scenarios here in the past few months where investors who had a max risk on a credit spread actually lost more than that on the specific trade. So we want to show you and identify the potential scenarios where a credit spread that with defined risk can actually lose more than that. And more importantly, we'll show you how to avoid these types of scenarios. Let's go ahead and get started. We think of vertical spreads, whether you're trading a debit or credit spread, as defined risk strategies, meaning you cannot lose more than the max risk of the spread. But there are certain scenarios where you can find yourself, usually around expiration, where you could risk more than what is defined as that max risk. So let's take a look at those three scenarios that can potentially happen, and more importantly, how can you avoid it? So the first one is when you're selling a credit spread on a stock or ETF. This doesn't happen on index options because the way that index options are settled in cash avoids this scenario. So this is referring to when you have a credit spread that's expiring and the stock is in between the two strikes. So the short strike is in the money and the long strike is out of the money. When this happens, you will effectively be assigned on the short strike, and you'll be assigned on the short option, which means that you'll be long or short the underlying stock, but your long option, because it's out of the money, will not be assigned. Now, if you do nothing and Monday morning you either are long or short the stock, you'll find yourself in a position where you are now exposed to that stock. And if you don't close that stock position, or if the stock opens substantially higher or lower on Monday, you could potentially expose yourself to more risk than the max risk that you had on the credit spread. The second scenario that you can find yourself in is even more rare. And this is really where the short strike or the credit spread that you've sold actually expires out of the money on Friday's close. And many times investors, when they see that their credit spread is expiring out of the money, they'll simply leave it to expire worthless. But there are a few scenarios where the stock is expected to open significantly higher or lower on Monday. And what this does is it causes, despite the fact that the short option is out of the money, occasionally when a stock reports earnings after the close on Friday and the long holder of the call or put actually expects that the out of the money option that expired on Friday's close is going to be in the money on Monday, they'll actually still trigger an assignment on that out of the money option. And we saw an example of this earlier this year with Nike that reported earnings after the close on Friday. That's a fairly rare scenario, but it did happen, and some investors were caught out by this scenario. So be very careful. Look for events that are happening after the close on Friday, especially if you have an option that you believe is expiring out of the money. See if there are any FDA approval announcements that are coming out, earnings events, catalyst product launches, anything like that that is being announced after the close on Friday. You have to be aware of that for Monday's open. And lastly, early assignment. So when you are short a credit spread, if you are ever assigned on the short leg before the expiration date, this is really where it's somewhat rare, but when it does happen, you want to make sure that you understand your risk of the trade, because when you're assigned early, that in itself does not change the max risk. But if you hold on to the long position past the expiry date of the long call or put that you have on your credit spread, now you're left in the same scenario that you have in the first scenario, which is you're now long or short the stock and you're exposed to more loss or bigger losses than the max loss of your credit spread. So those are the three scenarios that you may find yourself in. 1 and 3 typically happen more often than 2, but those are the 3 possible scenarios that you might find yourself in where you could potentially lose more than the max risk of your credit spread. the primary question that a lot of investors have then is, how do you avoid this? The great news here is that it's really easy to avoid. Number one, you simply want to exit your credit spreads about 2 to 3 weeks from expiration. The rule of thumb here is that if you roll your credit spreads or exit your credit spreads 2 to 3 weeks from expiration, you will, number one, never have the scenario where one leg is in the money and the other one's out of the money at expiration. Number two, you will rarely get assigned early if you roll your credit spreads 2 to 3 weeks from expiration. Now, for those of you that sell very short-dated options, so perhaps you're selling a credit spread that expires in just 1 or 2 days and you don't have the luxury of closing out 2 to 3 weeks in advance, just make sure that by the expiration date, by 3:30, 3:45 p.m. before Friday's close, that you close out your position, especially if you have a position that may be just out of the money and might open up in the money on Monday. And the second scenario, which is if you get assigned early, best practices when you're assigned early is to simply close out both legs, the stock leg and the long option leg that you have left. If you do that, you will maintain the max loss on that credit spread. I hope that you have found this useful in giving you a better understanding as to how to manage credit spreads, understanding the main scenarios as to when you could potentially leave yourself exposed to more risk than the max risk on a credit spread. So please, if you found this useful, please hit subscribe to our channel. Make sure you hit the notification bell so that you are notified when we upload a new video. And please leave a comment in the comment section and let us know, have you ever been in a scenario where you lost more money than the max loss on a debit or credit vertical spread? Thank you so much and have a great day.